name is Turney and I'm the CEO of Kavango Resources. We are a specialist metals exploration and mine development company with a large-scale copper exploration project in Botswana and gold mine development projects in Zimbabwe. We have just recently raised £6.5 million in a direct subscription to take us through to mine development, and over the course of 2025, our focus is going to be on building significant cash flow generation within the business.
Ben, good to see you. It's been a while. And with some good news to be. So how did this come about? Where's the money from, and why now?
Why? Well, if I start in reverse order, why now? We've recently announced our plans for 2025. Over the course of 2024, we made a lot of progress on the ground in Zimbabwe and in Botswana. Particularly in Zimbabwe, we've identified what we believe are what could be quite major gold discoveries for a business of our size that we're keen to bring into production. We have Prospect 3 that looks like it has the profile of an open pit operation with a heap leach that we're going to hopefully bring into production by the end of the first half this year. And then at Prospect 4, we have a high-grade underground operation that we're looking to bring into production by the end of the year. So we're raising the money now to give us sufficient working capital to enable us to fulfill all of these plans over the course of next year. We've obviously had to take into account sort of market conditions. We know how difficult it is out there. This is the worst bear market that this sector has probably ever faced. So we had the opportunity to get the money today. That's why we've taken it. This now funds us through to the end of next year. So it's a very exciting development for the company. We'll be announcing who's behind the money when we come to publish our prospectus at the start of next year. So that will be in the first few weeks in January. At this stage, it is a conditional financing that is subject to prospectus, but we'll be releasing those details first thing in the new year.
Are you talking about like one funder or multiple?
We have several funders behind us, and there will be more.
Okay. Okay. I won't push you on that one. Because you're not allowed to tell me. Okay, well, let's take a look at how you decided on the quantum of the money. Like, given where you are today, right? You know, your market cap where it is today, share price like everyone else has been battered. Why raise so much money? Why not sort of carefully put in small amounts of money?
This isn't a market where you can do that, Matt. This market's dead. And the piecemeal approach, looking to try and finance a bit here and a bit there, and the market sort of recognizes the progress you've made and your share price goes up and then you raise a bit more. We've shown this year we've made significant progress. We've made what look like they are genuine commercial discoveries, not the piss and wind that you can see from a lot of companies where they invent these so-called resources. They never really have a hope of financing or bringing into production. We've got genuine gold discoveries that we can take through to production. Now, in terms of the quantum, we've taken on a mining engineer from Australia. He's got a lot of experience in modern mechanized mining methods, particularly the spiral decline method of mining, which would be a very exciting development in Zimbabwe. He has a lot of experience working on the lode gold systems in Western Australia, so we've really got the right guy to work with us. Plus, he's also spent a number of years of his career working in Southern Africa, and the models that he's put together for us for bringing both Prospects 3 and Prospects 4 into production, we've based our decision on our financing on his numbers and his budgets that he's put together for us. So this is a carefully constructed plan. We're obviously restricted from how much we can actually say what we see internally. There are market restrictions on what you say in terms of forward-looking statements and the data that we have available to us. But with what we've seen on the ground, we're extremely confident in both of these plans, and that's really what's driven the size of today's financing.
Right. Okay. Well, let's talk about the allocation of capital, because that's important. When I sort of sit back and I sort of look at your project, there's a lot of optionality, but with a lot of optionality comes liability. You got to fund the stuff to be able to move it forward. You've got also operating in two different jurisdictions, Zimbabwe, Botswana. So how do you work out where the money goes, and what have you decided?
So our focus now is all about free cash flow generation. We obviously have the large-scale exploration project in Botswana. That is still greenfield. It's still early days. We've made fantastic progress on that project as well over the course of this year with Dave Catterall, who's one of the region's leading exploration geologists, heading up our field exploration there. But again, the market doesn't really want to see that now. So for greenfield exploration, we will have less emphasis on that moving forward as we get the business into a very strong, robust financial position when it can not only stand on its own 2 feet, but it can actually fund its operations moving forward. So the vast majority of this capital will be going towards our projects in Zimbabwe and the focus on free cash flow.
Okay, and talk about Zimbabwe for people who perhaps new to Zimbabwe as a mining jurisdiction. I mean, who's there?
At the moment, hardly anybody. You have Caledonia Mining, who are based on a greenstone belt about 70 kilometers away from where we are. They are the major listed company in Zimbabwe that everyone knows. Ariana Resources has recently taken on a project it's about 140 kilometers actually to our west. It's 70 kilometers west of Bulawayo. That's a much more technically demanding project. It's underneath cover, similar to the work that we're doing in Botswana. But in terms of what we're doing and what we're looking for, you have a lot of Chinese operators in Zimbabwe, but that tends to be much faster money. They focused on much nearer surface opportunities and processing of dumps. In terms of the exploration that Kavango is doing, we're pretty much the only company that is in the entire country doing this kind of work. And we talked a lot about our first mover advantage. Again, I don't think the market has really believed us, to be perfectly frank, what that actually means. But you have these 22 Archean greenstone belts that run from the northeast to the southwest of the company. We have a map that's in our presentation and we regularly promote, just showing how big the opportunity is in Zimbabwe. So at the moment, it's really a virgin opportunity for Kavango to pursue.
Right. Okay. But what do we know today? Because first mover, virgin, all of these things say someone's going to be learning on the job. There's not a lot of data, or is there?
There's an enormous amount of data in Zimbabwe, because if you look at the 120 years of gold production in that country, it followed a very similar trajectory to what you saw in Western Australia that gave birth to the gold mining boom. So the opportunity in Zimbabwe for us today is it's like being in Western Australia 50 years ago, but with modern technology, modern mining methods, all of the hard lessons on how to explore for and then develop these specific types of ore bodies have already been learned. It's just no one has done this yet in Zimbabwe. We are the first to do that. Even Caledonia Mining, their main blanket mine is based on the large shafts that they take. And obviously, when you're mining via shafts, it's more dangerous, and you have production limits based on how much you can haul to surface. With the spiral decline method, you can produce up to 10 times what you can through using traditional shafts. So it's by applying this modern, innovative thinking, backed by the experience guidance of the mining engineer that we've taken on, bringing these methods and this style of mining into Zimbabwe, it opens up an enormous opportunity. Focusing on the specific green belt that we're on, this is a greenstone belt that's got prolific historic high-grade production. You have these Archean greenstone belts that are set against these granitic intrusions, which are known the world over to be highly prospective for large-scale gold. And there's been next to no drilling there in the last 25 years. So it's no coincidence that the first holes that we drilled, we hit what we did in terms of the results. So I'd love to say it was all down to the genius of our team. Our team is fantastic and they work very hard, but it really speaks to the low-hanging fruit that exists technically in Zimbabwe to bring these kind of discoveries into production.
Okay, so you're focusing on Zimbabwe hillside, and we'll talk about Nara in a second. So let's look at some of the results that have come back with. Let's say we start with Prospect 4. I mean, what do investors need to know?
So the highlight of that, the first hole that we put in, we hit. The highlight was a 2.5 meter intersection running at 29 grams a ton. Now, Prospect 4 is currently being mined by contract miners who are working through Kavango Mining, our subsidiary. They are mining 4 of 8 reefs that have already been mined by artisanals. Our team believes we've actually identified 12 reefs, so 12 gold-bearing systems over a 250 meter width and what we believe is potentially 1.5 kilometers long. These guys have gone down to about 30 meters, so they barely scratched the surface. But from the ore that they're producing, we're seeing average grades upwards of 9 grams a ton from the material that they're producing on a very small scale. The model that we've built for Prospect 4 and the larger scale underground mining, we're working on the basis of 3 grams a ton. We actually think, and on the basis of 4 of the 12 reefs being mined at any one level. So we've built a very, very conservative plan. If we're able to meet the objectives within that project alone at 200 tons a day will be generating over $500,000 of free cash flow a month. And that really is only the beginning. This ore body, if it meets our expectations from what we've seen from the surface work we've done and the drilling, this could be a much larger scale body that potentially could be producing 1,000 tons a day within a few years' time.
Well, let's look at that bit, because that's the exciting bit. Like $500,000 a month, it's whatever, right? But what I have noticed is companies trying to come at the market differently. You reference it, the market's kind of broken, quite frankly, in terms of funding, and companies looking for self-funding seems to be de rigueur at the moment, and I think wisely so. I haven't always thought that, but I think right now that's what people need to look to. So tell me more about your thoughts around how Prospect 4 could evolve.
Well, you started to hit the nail on the head right there by saying you're right. The $500,000 a month free cash flow, that's not going to get the market excited. But what that is going to enable us to do is to self-finance the larger scale technical work we need to do to fulfill that entire ore body's potential. Obviously, to build up a larger resource and to build up a larger mine, you need a lot more money to be able to do that. It requires a lot more drilling, a lot more surface work. There's a lot more engineering that's required as well. The traditional model, up until a few years ago, companies would look to build up a big resource and then try to secure mine finance to take that through to production. Well, we've seen this year with some of these larger companies in London that have already failed because having done all of that work and spent tens of millions of dollars along the way, when it's come to the actual mine finance, they haven't been able to secure it, and they've ended up in complete disasters for shareholders and zeros. That's why we're following a very different approach. We're looking at taking a staged approach to building up cash flow, meaningful cash flow, to enable us to self-finance development of this mine. Within 3 years, Matt, this one project, and one point I'd like to make it, we're talking about a 90-hectare block. This is not even a drop in the ocean. This is a tiny block of ground that within 3 years could be generating between $2.5 to $3 million of free cash flow a month on one project. We've got obviously more projects within our existing portfolio, and then there are even more projects within the Greenstone Belt that we're working on, which are completely capitally constrained, and we're the only game in town. So in terms of our potential for earnings growth, if we can deliver on our plans and we can become this specialist mining company that specializes in developing, in exploring for and developing smaller scale underground mine opportunities, we've got potential here to build a very, very big business.
Okay. So start small, expand, and take it from there. Okay, that's the message to the market.
Basically, exactly that. So with the first two projects we've taken on, we've got about 900 hectares in our entire portfolio. Again, it's tiny compared to the overall opportunity. Start small, build up the cash flows, get ourselves to a point where we're self-financing, and from there take on other exploration options, just as we've done with the first two projects. I think another part of our model that the market hasn't really grasped yet is the nature of the options that we've signed with the project owners. These have given us time to go and do our proper field due diligence, get our team on the ground to do the surface work, the mapping, the geochemistry, get our drilling company that we now own 45% of to come in and actually drill test these targets. So before we actually exercise the options, we know what's under the ground and what we can develop. So I think that's a very key part of our business model to understand. Once we've made it work in these first two projects, I can see us moving up to a point where in a few years, we'll have a dozen of these projects within the Philabuzi area. And that's how we're going to get to our overall target of 10 million ounces. We're looking to build a 10 million ounce gold camp within this Greenstone Belt. It's a very ambitious plan. It's a long-term plan, but by taking the steps that we are towards cash flow generation, I think we've got a very strong chance of executing this.
Okay, so look, talk is cheap. We've seen that in the marketplace at the moment, and ambitions are one thing, doing it is another. So the realities of getting projects funded, I kind of like the idea of starting small and getting some revenue, sort of be self-funding in a way, or at least mitigating dilution for your shareholders. Good. But are people interested in financing these small projects, either in London or even locally in country? We've seen a lot of that going on, high net worths in country financing these things. So how do these small operations actually attract money?
I think most of them really struggle because most of them don't have the business model that we do. We've been able to finance our operations as we've shown today. I mean, Matt, we've just announced £6.5 million coming into the company in fresh capital. We have more that is already lined up. And it's an interesting point you raise about local money as well, because we've also got extensive contacts within Zimbabwe. We've made a lot of pitches to significant institutional investors there. And I expect hopefully there'll be some news on that in the near future, in parallel to our planned listing on the Victoria Falls Stock Exchange. So we've got a very clearly defined strategy for how we're going to raise the money. I can't speak to the rest of the market. I look at most of the other deals that are out there of companies that are our size. They're raising $500,000 or $1 million here and there. You can barely keep the lights on in a business like this. These sorts of businesses, they'll just wither and die on the vine. And I understand that the pricing of today's deal is difficult for shareholders. I'm a significant shareholder myself. But what we've had to do is what's right for the business. We've raised a significant amount of money now so that we can finance our projects through to significant production. And I think that's a really key point to understand about Kavango, and that's what sets us apart from our peers. We could have followed the other approach, raise a bit here, raise a bit there, there, pay board salaries, pay advisor salaries. But frankly, who's interested in doing something like that? I'm certainly not.
Okay, bit of ambition, a bit of aggression. I kind of like it. Let's go to prospect number 3, if we can, because I want to kind of cover the everything that's on the table, and then we'll bring it back together at the end. So what's happening over there?
So here we've got, it's at its widest, it's about 200 meters wide, down to about 100 meters wide, and it's 800 meters long. It's open at strike and also open at width as well. This is an area that's been heavily mined by the artisanals. We've got the 3 drill holes that we put in return some really encouraging gold grades. We've got very long widths, the intersections are very wide, from what we believe look like commercial gold. Now, when our mining engineer came out to come and review Prospect 3, and he actually walked the ground and he saw the number of parallel reefs that we have. We've got at least 18 mapped parallel reefs in this ground that are all producing gold. Now, from an open pit perspective, if this were just a virgin opportunity that hadn't been mined by the artisanals, it would be something you'd knock it out of the park. However, the artisanals have got in there and they're down to about 20 meters, we believe. But just underneath that, where their work stops, where they're limited from how deep they can go down by the methods that they're using, and particularly this sort of hand-driven style of mining, underneath that, there are some very interesting opportunities. So what we're currently doing is resource drilling. We're drilling out the first grid on this prospect to see if we can build a resource that we can create our first small open pit mine. And the idea here is we want to produce a 30,000 tonne a month heap leach operation, where we'll build a succession of 6 individual leach pads using concrete, which obviously will then have a lining on top. And each month we'll fill one of the leach pads with upwards of 30,000 tonnes of material. We'll put it through the heap leach process. The following month, we'll fill up the next one and then leave the material on there for about 5 months. At the end of that, we'll then clear that off and put the next month's material on. The plan is to mine this on 10-metre benches, and we've marked out an area that's 100 metres wide and 150 metres long. So it's quite a small operation at this stage, but that could be generating upwards of 15 kilos of gold a month by the middle of next year, which in revenue terms is give or take around about $1.2 million a month. So that operation, again, it's not bad. It's certainly not anything that's going to set the world on fire, but what it will show is our team's ability to bring a project like this into production quickly, and the $200,000 or so a month of free cash flow that generates, that will make quite a meaningful difference to our business on top of what we're already mining at the moment. So the real advantage of this project is the speed at which we can bring it into production. And then if we're able to explore and demonstrate that the strike extension continues and there's more continuation at depth as well, this is an ore body that could actually surprise people the deeper into it we get. So watch this space and let's just see what the results tell us in the first part of next year.
Okay, well, let's talk about that, getting into production quickly, because some might go, well, that's a bit cavalier. What about the processes that companies need to go through with studies and so forth? How can you manage to get into production so quickly?
Yeah, it's an interesting thing about this industry, isn't it? We're so used to hearing about these long, lengthy pre-feasibility studies and feasibility studies and bankable feasibility studies and God knows what else that needs to go into these things. If you look back in the day, sort of pre-BRIEX, when large-scale mining operations were done, you obviously have to do your feasibility work. It would be cavalier and foolish just to charge into mining without having the relevant data. But in terms of a lot of the steps that are required, well, I say required, which the market has come to expect, a lot of it, particularly for an operation like this, is actually largely unnecessary. So long as we can demonstrate that the resource is there up to an indicated standard, and that comes down to drilling diamond holes on a sufficiently tight grid to give us that level of confidence, and then following up with infill drilling, grade control drilling, so we can then confirm that the grade is there to give us confidence that the metal is there at a sufficient volume, at sufficient grade. It's then literally a case of we bring in excavators and we start mining and we put that material onto a heap leach pad. It's really not rocket science. There's obviously work that needs to go into that, and it's that work that we're doing now. We've made that pitch to our investors. We put this out in the RNS that we released last year. I think this market is just so used to these projects taking so long that people have been conditioned to think, well, this must take years to bring into production. We've been talking about this opportunity that exists in Zimbabwe. It's like being in Australia 50 years ago. Frankly, the market doesn't believe us at the moment. So do you know what? We're going to stop talking about it and we're actually going to show the market what is possible.
Okay, so it's very, very different mining from prospect four. This is lower grade heap leach. It's entirely different process. But you feel that again here, starting small and building up is the right model. That's the thing they have in common.
As long as it can pay for itself and make a meaningful contribution to our bottom line, then I think that is the strategy that makes most sense. And you're absolutely right. This style of mining is very different to what we'll be doing at Prospect 4. There is more technical work we need to do at Prospect 4 because that is a more complex engineering challenge. For the open pit style of mining that we're looking to pursue at Prospect 3, assuming that the resource drilling we're doing at the moment delivers the results, that's then the next investment stage gate for us to move forward in the project. If the results don't go in our favour, then we have another grid that's blocked out that we'll go and drill test that. And if that doesn't work out, then we'll focus our energies onto Prospect 4. So our plan, we don't feel we're being too cavalier. We're not just charging in there. We are moving quickly, but we've got a very clearly defined stage-gated approach before we actually commit to the mine construction.
Okay, and typically, I've seen this work elsewhere, South America predominantly. And heap leach is a relatively simple process. I agree with that. Can you give us a range in terms of the cost and the money that you're going to need to raise, and also what are your thoughts around how that gets financed?
So in terms of how it gets financed, again, I'll start in reverse. How it gets financed, we're in a position where we're going to be able to finance all of these plans through direct equity. So the financing that we've announced today is a big step in that direction. And we have another deal that we're lining up at the moment, which will provide us with the remainder of the finance that we need for the rest of 2025. So no exotic instruments, nothing too complex, straight equity coming into the business. The business will pay for itself and we will live or die by the results of that. It's really that straightforward. In terms of the capital requirements for Prospect 3, our budget at the moment is for $3 million. Now, that is an overestimate. We've gone in with pretty high cost base, and we're working on the basis of a break even. Well, it's profitable at about 1.2 grams a ton. So that's really the sweet spot for us. We need to identify a resource at 1.2 grams a ton or greater. Now, the results that we've had that have already come in for the near surface on these high grade reefs, what we'll be doing this, and again, I think this is something that maybe we need to communicate better to the market. I think the market's expecting us to come in and just scoop all the material out and we'll come out with an average grade. We're actually going to be pursuing a selective mining approach on this because we recognize these individual gold producing veins are much higher grade. So we'll be taking out the ore in individual sections based on the position of the veins, and then the other material, the waste material, we'll be putting that to one side. And we're working on the moment of a waste ratio of around about 7-1. So for every ton of ore that we take out, we're expecting 7 tons of ore will go into waste, which we've got plans for how we'll actually store that and put that sort of in an environmentally safe way. In terms of Prospect 4, there's more work that we're doing. Much will depend on whether we are able to put the spiral decline in as an exploration decline. But the plant itself is going to cost us about $2.2 million. Now, the initial results that we've got have just come in from the metallurgical testing that we've done with the South African plant manufacturer. They've done some excellent work on that. We'll be putting some news out about that in the near future. But from what we're seeing so far, we're confident that we're going to be able to fill that plant with 200 tons of material a day. And the business model for that, again, is based on, at the moment, on an average grade of about 3.2 grams a ton. That's on the sort of one of the better case scenarios for us. The break even is around about 2 grams a ton, just under 2 grams a ton. And we are confident we'll be able to fill that plant with material because there is so much ore in the region that isn't being processed in this way.
Okay, so 3 million and would you say 2 million?
Yes.
2.5 million. I mean, what are the other kind of running costs? Because those numbers are absurdly low. What do you do around energy? You know, is this diesel operated, or what do you do about water? I mean, what are the other kind of factors which are going to hold you back?
So we've done comprehensive desktop studies. So the mining engineer's been over to site twice. He spent 2 weeks now on the project, spent a week up in London. Both projects will be energy independent. Because obviously one of the big challenges you have in Zimbabwe is the unreliability of the national grid. So we've designed everything that will be energy independent through a combination of solar and, as you rightly point out, diesel generators. So our base case, our worst case scenario is on the fact we have to fuel these things directly ourselves. We expect we will be able to draw from the grid, but obviously that will add to the overall, improve the profitability. The grid down there, it's not been so good in the last couple of months. months, but over the course of the rest of the year, we've had pretty reliable power service. In terms of water, we've already done built into our plans further water exploration. We've successfully identified and drilled 4 water boreholes. I just got a report this morning, actually, that one of those water boreholes is producing at 17 cubes an hour, which is fantastic. It's more than what we need. We don't know what the depletion rate will be. That remains to be seen. But we're confident that the geophysics that we're using, so the technology we're using to identify where the water is, that is working well. So we've got plans for drilling another 8 water boreholes in the first half of next year. So again, part of the trick to working and operating in Zimbabwe is to make yourself as independent from the grid and the system as you can. You need to have a standalone business model, and that's all built in. To address your point about this all sounds absurdly low, I've been in this game now for 15 years, and I've also been conditioned to these huge, crazy figures for mine development and the capital requirements and this very linear way of thinking. Well, we're pursuing a much more entrepreneurial approach down in Zimbabwe, as you have to. We know that it's a difficult jurisdiction to operate in, but we are making it work. So while those figures might seem absurdly low now, again, watch this space. We've got confidence in our plan, in our team, and in the projects that we have.
Okay. So what are we looking for in 2025? What are we looking out for? Because we're like at the end of the year now. This money's got to actually get in the coffers. How do you kick off the year, and where do you think you'll be at the end of it?
So we're already into resource drilling at Prospect 3. We're going to immediately start the next phase of drilling at Prospect 4 on the 6th of January. So those plans are all ready to go. We need the results from both of those to be able to move to the next investment decision. But what I've been working on in parallel is I've been thinking about, well, what is our plan B in case those results don't work out? We have other options that are open to us, other projects that are available, but we've got a lot of confidence that the results will be favourable for us based on all the other data that we've gathered. Once we get to the end of Q1, we expect at that point to make the final investment decisions on commissioning the heap leach operation at Prospect 3 and commissioning the production plant to be brought into country. We'll need to do more work at Prospect 4 to confirm whether the production plant will go to Prospect 4. If it doesn't, we're going to take it to Prospect 1, where we're already mining. And that plant, we've already done the met testing. We know that it can process ore from both Prospects 1 and Prospect 4. So again, our plan has not only a lot of fat built into it, we've got contingencies as well. So by this time next year, we want to have a fully operational heap leach operation that's up and running. And one of the points I should have also made, Matt, is that with the production that we're actually doing at the moment from Prospect 1 and also Prospect 3, we know that the material that's being pulled up, the ore, it does actually respond very well to leaching. So we're confident that we will have a heap leach operation up and running. We'll have the production plant up and running in Zimbabwe, either at Prospect 1 or preferably at Prospect 4. And in Botswana, we'll have continued our exploration program there. And I'm hoping that we'll have some very good results to put out for that in the new year.
Okay. We will be following you. Let's bounce over to Botswana, if you don't mind. As you say, focus Zimbabwe, but you've got some assets in Botswana. How do you play that this year?
So I think one of the things we have to look at is how we take this project forward. It's obviously greenfields exploration, and the market doesn't want to pay for greenfields exploration. We've been pursuing what Dave Catterall calls the vectoring strategy. So the drill holes that we've drilled this year have been designed to give us data that we need on the system to tell us where in the system we are and where the economic deposits might be. We're very encouraged by the results that we've had. It looks like we are getting close to a number of potential copper deposits. And just to emphasize there, that's several, not just one. So the drilling, technically it's been a big success, but of course, market doesn't care. We have to adjust our strategy on the basis of the fact we are a publicly listed company. So what we're now moving into there is we're going to do some follow-up geophysics. We've identified what looks like a very large target that we need to get some confirmation of from the next round of geophysics that's currently underway. If we get that confirmation, we're going to go and drill that target in the new year. And our hope is that will take us to the contact point of the Dakar and the Nguako Pan rock formations. And it's that contact point that controls all of the mineralization through the region. Commercially, we've got a number of NDAs already signed with large companies. These have all been from inbound leads, so we haven't actively gone out and promoted the project. But starting in the new year, I think it will be time for us to start taking our data and our data room, show it to the parties that we already have NDAs with, and also do a bit of a marketing exercise just to see what appetite there might be out there for potentially a larger JV partner or a deal of that kind of making. If we look at the amount of interest there is in the copper belt, we have a map that's on our website which shows that we have the last large remaining land package in the entire belt. Everything else has been taken up by Rio Tinto, BHP Billiton, Sandfire, and the Chinese group MMG that bought Zone 5 last year for $1.85 billion. So it's true elephant country. We control the southern margin of the belt in Botswana. We've got highly prospective ground. Again, we don't feel that value is reflected in our current market cap. So I think what our job next year is to build up some more of the technical data that we have and then take that to parties that really understand what they're looking at and see what kind of a deal might be available to us.
Okay, well, we'll come back to that. Obviously, some big players in there with big balance sheets, etc. So in the right postcode, I say focus for you, Zimbabwe makes a lot of sense. I appreciate the update. And I do like the ambition. Now you just got to go and deliver. Appreciate your time today, Ben. Please stay in touch.
Thanks, Matt.